You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, last week we looked at some alternatives in the FANG area, how to use options as they were originally intended, more so to reduce risk as opposed to add risk to your position. We talked a little bit about a collar and apple. We talked a little bit as using a high delta option as a surrogate for Facebook stock, which has recently been beaten up a little bit. And we are taping Options Playbook Radio on the 5th. It is a Wednesday. The markets are closed today because of the passing of one of our past presidents. So today we're going to take the market conditions and we're going to do a quick trade. And it's mainly because of what happened in the volatility index. On Tuesday, we saw a big run up in it, over 4 points, up to about 26%. And so that puts the volatility index back to where kind of its norm's been over the last couple of months, ever since basically October 1st. We've seen the VIX index trade north of 20. It came down a little bit. Now it's back up there again. And because of that, when we have high volatile markets, butterflies are cheap. When you have increased implied volatility and a butterfly where you're selling two option contracts that are fairly close to where the underlying is at, it makes those butterflies cheaper. And then what you want to happen over time is either for the options to erode as expiration approaches or for volatility to come in. And that helps make the butterfly more expensive, if you will, which is a good thing if we're going to sell it, especially if we are correct on our forecast. So I'm going to go to an old standby strategy that has built into it, I guess I would say, a hedge. And what we're going to look at doing is, and I've talked about this before in Options Playbook Radio, but I only like to look at it when the conditions are fairly decent in the marketplace. And by conditions, I specifically am talking about the volatility index, the VIX. The VIX is based off of the S&P 500 index, so that's the index that we're going to use. And as always, it's not meant to be a recommendation, so we're just trying to learn. And we talk about strategies when the market conditions are right, more so than focusing on where the underlying market is going. So we're going to do a out of the money put butterfly in the S&P 500 index with a very short-term expiration. And that is trading for a very reasonable price relative to, let's say, 5 months ago, because the volatility index is currently at 20.74 right now. So if we do this, The ideal scenario would be that the market would come down to our short strike over the next 2 days, because it's going to be a very short butterfly. A friend of mine, Dan Sheridan, calls it a time bomb butterfly because of that. Just really short focus on the markets. And if we are incorrect on our forecast, we're going to actually roll it into a short put spread, and that's going to be our alternative. But we have to make that decision basically before the close tomorrow, because this is a very short-lived trade. So let's get to the trade. All right. As I mentioned, today is Wednesday, the 5th. The markets are closed, and they were closed all day because the markets were not open. And we are going to look at the S&P 500 index. Last price on that was 2,700.06. So 2,700 is the magic number here. And we are going to buy a December 7th expiration butterfly. We're going to pay a net debit for this butterfly. And the strikes that we're going to use is we're going to stay fairly close to at the money. We're talking about a 20-point wide butterfly with every one of these options is going to have a December 7th expiration. It's got 2 full trading days to live. These are part of the weeklies, so they do stop trading after the close this Friday, the 9th. All right. The first strike that we're going to buy is the 2,700 strike put. We are then going to sell 2 of the 2,680 puts and then buy 1 of the 2,600 puts. We're going to do this right now. The midpoint is at $2.25. If we can get it for that, that would be a solid price. And that means our total risk on this trade is $2.25. If we do this trade, we definitely want the market to stay within the strikes. We have to look at the net debit that we paid. The maximum this thing could trade for would be 20 points, the width of the spread. Now, that would take a little small miracle to happen, in that the market would have to go out right at the expiration on Friday at the close of the market at the short strike, which is 2,680. But our max gain then would be $20 minus the net debit paid, or $2.25, and that's $17.75 is the max upside. Now, if you ever got that upside, you really should receive the stupid award, and I mean that in a lighthearted fashion, in that there's no way you should have stayed in until all the way till expiration. If you got a decent profit, let's even say you're up 100%, you can sell the butterfly for $5. You got to get out. You really just need to not be in the trade anymore. So with that said, let's talk a little bit about our forecast on the market. So if we're looking at the S&P 500 index being a 2,700 point index, our ideal scenario would be that the market would drift down towards the 2,680 level, which that's a 20-point move. So 20 points divided by 2,700, you're talking just about a 1% move that you would like to the downside over the next 2 days. You would like it to be a slow drawdown, but if it's not, that's okay. We're just going to have to deal with the trade. But we also have a 40-point range that should be okay on this trade. If it stays anywhere between the lowest strike on our put butterfly, 2,660, and the highest strike, which is 2,700, we're in this, nice range for the S&P 500 index. Now, what else could happen? Well, we could have a big open tomorrow, and the market could start to skyrocket to the upside. Now, the biggest thing, the reason why I kind of like these butterflies in the S&P 500 index is you usually don't have a 20-point gap opening or a 25-point in the S&P 500 index. The volatility just isn't there. It's not like you get an earnings report in a stock and it opens up 50 or down 100, that type of scenario. So it allows you to trade this position. So let's say tomorrow the market opens up and it opens up 5 points, and before we know it at noon, the market's trading 10 points higher. That would be 27.10 is where the market would be at if it was 10 points higher. What we want to do is look at this put butterfly and say, okay, if the market starts drifting that way, we're going to roll this into a short put spread. Now, this is going to increase our risk, so we really don't want this to happen. But if we do this, it gives us kind of a, I don't want the cheese anymore, just let me out of the trap. And right now, if we look at the trade that we would do to hedge this, we would look at the total cost of that trade. So here's what our hedge would be. We would go out and sell the highest strike put that we are long, the most expensive one, the 2700 strike put. We would sell that to close, and then we would buy another one of the 2660 puts. All right. Effectively, that puts us in a 2x2 short put spread, which wants the market to continue on up or at least stay neutral, stay where it's at. We just don't want it to drift back down. And we would be short 2 of these because of the way the whole process works. And it's a 20-point wide spread. So you're talking about real money here as far as the requirement is concerned. We're talking about a $4,000 requirement. So to put on this entire trade, what we really need in our account, we got to be prepared to use, is $4,000 plus the debit of $2.25 or $250. That's what we're looking at as capital to put this trade on. So if we do that trade, realize then you would be in a 2,680 by 2,660 short put spread, but only for a couple of days. The markets have been volatile recently, and that's part of the reason why this trade is attractive, but the market at that point in time would be about 30 to 40 points out of the money relative to the short put that's driving this strategy. All right, so there's a lot to unpack there. So let's go back and let's review it one more time. The market is closed right now. It is the 5th. It is a Wednesday. We're going to look at the Friday expiration. We're going to do a out of the money long put spread. It's going to be 20 points wide. We're going to buy the 2700 strike put, sell 2 of the 2680 strike puts, and buy 1 of the 2660 strike puts. It is done for a fairly low cost relative to what is done previously, mainly because the volatility index is high. It's trading at 20.74. The midpoint of this trade is $2.25 or $225. If we do this trade, we would like the market to drift slowly down towards our short strike. If it goes down at all, we're in the sweet spot. We hope that it stays within a 40-point range, which is 2660 and 2700. If it drifts higher, we then look to roll into a short put spread, which means we would be selling the 2700 strike put and then using those proceeds to buy a cheaper put, the 2660 strike put, effectively putting us in a 2x2 short put spread in the S&P 500 index. And if we do this trade, it means the market is trending upward. So we're doing it into an upward trending market. And then we just hope that the market stays above 2680, which is our short put, and it stays up in that range all the way to the Friday, December 9th expiration on basically the close of the market on Friday, December 9th. All right, well, it's going to be a short and sweet trade. We'll come back next week and we'll actually look at how it did. So that's it for this episode of Options Playbook Radio. If you'd have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back again at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.